Hello, everyone. We are live. Welcome back to another live episode of Be the Boss of Your Money, because I want you to be the boss of your money, not your money to become the boss of you. It's very easy for that to happen. So I'm just working the controls here at my fingertips. I've got all kinds of screens and everything in front of me to make this show as good as possible. The big topic is the stock market really in a new normal? Is this really a new normal for the stock market? You know, I don't think it's really as much of a new normal as some people say it is. I'll explain, and you're not going to want to miss this. So let's roll the introduction. Stick around. Okay, welcome back to Be the Boss of Your Money. This is a live episode. The fun thing about live is you never know what's going to happen, and you never know what I'm going to say, because, sometimes a fun little gaffe, maybe a four-letter bomb will drop once in a while, and oh my God, all hell will break loose. I think that's okay to say. So anyway, welcome back. Really appreciate you being here. I want to talk to you about the new normal. Is the stock market in a new normal, or is the new normal just a bunch of hype to get you to listen to some marketing hype and fear-based selling? We're going to take a look at this, and then you could decide for yourself if we're really in a new normal, or if the stock market is just the same old, and you need to tune out all of the new normal sales hype BS. Anyone who watches the show knows that the first thing I like to do is do a quick review of the day's market action. And this is going to be quick because I've only got 3 screens. I'm just letting you know. This is just a quick review, quick summary. You can find a summary for the most part anywhere, but the important thing is I add perspective because I've been doing what I do now for over 30 years. I am old enough to say that. Young enough to remember, old enough to know better. That's an expression a friend of mine used to use when people asked him how old he is. So I like that. I'm going to stick with it. Okay, so the Dow off 170 points. Nothing major. Keep in mind, 170 points by today's standard is pretty tame. S&P off 11 points. NASDAQ up. Of course, the NASDAQ is up, right? Why shouldn't the NASDAQ go up, right? So the NASDAQ is up slightly. And the Russell 2000, that's really the only major benchmark that I am following here that had a pretty bad day, down almost 2%. We'll get into that exactly why. And you see the VIX was off a touch, very tame VIX, which kind of goes hand in hand with a very tame stock market. If you notice here, the S&P 500 was only down 0.36%. So the VIX was off almost 0.6%. So typically the VIX percentage-wise has bigger moves than the S&P. The VIX is basically, we call it a fear gauge. It basically tells you that larger investors are willing to hedge their bets with downside protection. So when people are down, hedging, the VIX will usually go up. So we want the VIX to be down. Typically that means it's a stronger stock market. So when you have all green on your screen, you'll see the VIX red. That's a good thing. That's perfectly normal. Okay, let's take a look. Some of the market movers. Listen, Activision was up a little. Some of the stocks I follow, Lam Research. Okay, I want to point out the losers in the day. Norwegian Cruise Line down 8%. Royal Caribbean down 7%. Occidental down 6%. PVH, clothing, shirts, that sort of thing. Kimco Realty down 5%. And let's take a look real quick at the sector ETFs. Communications leading the way, some dividends in there. It's got some exposure to some of the larger tech stocks like Facebook. XLK, the tech sector, was, just about, barely off, just about flat, I'll call it. Utilities off. Everything was off a little bit, except for some communications and some tech stocks. Energy was down 3.4%. That's the only, and financials were down 1.5%. Those are the two big losers of the day. What I always say is you want financials to lead the way. When financials are leading the way, it's usually a good sign that things are working in the economy because loans are being made. It's really hard for banks to make money when interest rates are so low because remember something, okay? The way banks make money is that your savings deposit, your money in your money market, to you, that's your asset because it's your money and you're collecting a slight, I know, an ever so slight amount of interest on it. But if the bank is paying on that, they're the payee. I'm sorry. Yeah, they're the payee. They're no. But the bank is the payer, you're the payee. Thank you. So if the payer is paying money in your deposits, that means it's a liability. So your savings accounts and money market accounts and checking accounts are actually a liability of your bank because your bank's paying money on those. And if they're not using the money to make more loans, then what's it doing? The money's just basically collecting dust for the bank, and the bank is actually paying for that money. It's like paying vault fees in a way. So that's why it's hard for banks to make money, because if interest rates were higher, banks would have a bigger spread called the net interest margin. So if they let's say interest rates went up, banks could collect a little more interest on the money without having to pay you much more. So they would make a little bit more money on your deposits. Right now, banks make virtually nothing on bank deposits. So that's how it works for banks. Okay. So, and by the way, I talked about the small cap. Small cap stocks are considered economically sensitive, and they're also known to have lesser ability to get funding and loans and just hit up the capital markets for money to get through tough times. So that's a more cyclical space. So today was not a V-shaped day where everybody says, hey, we went down, swished down into the plunges, the depths of the recession in the bear market, and we're shooting out. The last few days, we've been talking about a V-shaped recovery, but today it's more like a U-shape. Small caps are basically saying the economy is not that good. No kidding. But the belief that the economy will get better to help small cap stocks just wasn't there today. So that was missing. So let us go on. I'm going to get rid of the share screen here. Boom, back to the close-up of moi. Okay, so let's talk about this. Are we in a new normal? I've got some notes that I'm going to go over with you. You're not going to see the notes. I'm just going to put them up on my screen. Okay, so basically, is it a new normal, or is it... So basically, is it a new normal, or is it something we've seen before? Is it the new normal, or is it the same old, same old? I don't think the stock market is really in a new normal. Not to say that being in a pandemic is normal. It's not. And what's happening with the sudden shock of the economy being shut down globally certainly is not normal. And we can say all of the superlatives and one time were new things about the stock market. We had a record plunge into a bear market. We had a record recovery out of a bear market. Now, some say we didn't even have a bear market because we were in so fast and out so fast. And some say we're still in it. We're just enjoying a bull market rally. And some people say other things. The fact is, folks, only time will really tell. For now, we have our predictions, but it doesn't mean we're doing anything differently. If you're an investor and you're a client of mine or some of the financial advisors that I know, you are investing regularly. You already created an investment plan, a retirement plan, a financial plan. You've done all these things before this pandemic happened, not because you knew about the pandemic and you knew about the bear market. It's because that's the proper way to invest for the future, to take into account market shocks and volatility. So you're probably skating through this pretty well. You're probably getting through this pretty easily. You're probably highly diversified. Diversification is a strategy we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Disclaimer right there. So but that's nothing really new to say that you've built a diversified portfolio to withstand shocks and that could recover from market shocks. So the other thing is that the Fed has been pumping up the stock market. Now, I don't want to be one of these conspiracy people that says this whole thing is built on the Fed. It's not all built on the Fed. I don't think what the Fed is doing is create. I don't think the Fed is what turned Apple Computer into a $1.5 trillion company. That's right. The market cap on Apple, the biggest company in the world based on market cap, if you take the number of shares, multiply by the price, you get a little over 1.5 trillion. There was a lot of fanfare when Apple hit 1 trillion in value, and not a lot when it hit 1.5 trillion. Maybe we're getting used to it. Microsoft is up there over a trillion, and so is Apple. And Alphabet, aka Google, is almost a trillion. It's in the $900 billion valuation range. So, so maybe you could say that's the new normal, but every cycle has had a new a new threshold in terms of how big companies could be. Look, over time, we're going to be looking at $2 and $3 trillion companies. I don't know exactly when, but in the future, I think it's fair to say that everything will become more expensive. So the Fed's pumping up the market. The Fed has kept rates now. Again, they just did another QE last fall. Rates are back down to 0%. Is that new? It's more like a continuation of what we saw about 11 or 12 years ago with Yellen and with Bernanke and Yellen. And now it's continuing with Federal Reserve Chairman Powell. Okay. Investors are trying to bet on the work from home stocks. Well, if you look at what's working, technology's been working. What's so different? That's been the case for over 10 years now, that technology has been the best place to be, and tech related. Companies like Salesforce.com, companies like Visa, which you might not think of Visa directly as a tech company. You might think of it as a financial company, but it's a payment processor that really is a technology company. And you see Apple, like I said before, Alphabet, Netflix. You see FANG plus M. So it's Facebook, Amazon, Alphabet, Netflix. The M is for Microsoft, G is for Google. Okay. I said Amazon, right? Apple. So same old here, folks. It's just basically more and more investors are crowding their cash into the same mega cap stocks at the expense of a lot of other stocks in the S&P 500. And now we're talking about, is it a V shape? Is it a W shape? Are we in a U shape? If you describe the economy, like W would be the economy, goes down, then starts to recover, goes down again, recovers, goes down. It's the same exact thing with the stock market. V shape, U shape. We like to assign classifications and letters to everything because it helps us understand. It helps us understand what's going on, and it gives us a reference point so that we're all on the same page. So Procter & Gamble, Costco, Walmart, Clorox, these were already big companies. People are buying them now, but they've already been doing some really good things. Macy's is down a lot, but Macy's had already been considered a loser in the fight against Amazon for a long time. Look, the point I'm making is I don't think this is as much of a new normal as it is the same old, same old. Investors are trying to pick winners and losers. Nothing new about that. The winners were already the winners before the pandemic started, and the losers now are pretty much the losers in a lot of cases before. Yes, it's hurt airlines, it's hurt hotels, cruise line operators, but to me, it's not something that's like so strange to understand that it's like a new normal. It makes sense. Airline, travel bookings are down. Then, travel and leisure businesses are going to get hurt. I don't think that is such a normal thing. Again, I'm not saying that a pandemic is normal. It's not. But they have happened before. This is not like we're in the first pandemic we've ever been in. As a matter of fact, as far as pandemics go, this is obviously the most widespread pandemic we've ever had because there are more people on Earth than ever before. But, the next pandemic will unfortunately be even bigger. So what else is similar or the same as always? We have an election coming up, and politicians will do whatever they can to make things as good as possible for the rest of us. because when voters feel good, they vote for incumbents. When voters don't feel good, they vote for somebody new. They vote for the challenger. So I mean, I don't think these are new things. I mean, when we were going through the Great Recession, uh, people were saying, oh, that's the Great Recession is sparking a new normal because people are going to crowd into the big box retailers like Walmart and Costco and Target. This has been going on for a long time. Every recession and bear market has a good deal or a great deal of destruction. In economics, we like to call it creative destruction. And then we rebuild stronger and better with new kinds of jobs and new businesses. A lot of people, by the way, don't believe in the government helping to educate people on the jobs of the future because nobody really knows what the jobs of the future are. Just a side note, I don't think the government or the Federal Reserve or any branch of Congress of the U.S. government. We have a bicameral Congress. So there's only two branches here. But anyway, the administration, I don't think anybody is better at predicting the future than anyone else. Just my view. Predicting the future is pretty hard to do, and most people are wrong, and they keep changing their minds until their prediction catches up to the present, and then they're right because their prediction was made 60 seconds ago. And yeah, making a prediction to what's going to happen in 60 seconds is pretty easy. But where were all these people, years ago with their predictions? Okay, so the only thing to me that is really, also normal, not the only thing, a lot of things are normal to me in this, believe it or not, because, there's an old expression that goes around Wall Street. This time it's different, and it's basically never different. Everything is a cycle. The cycles could sting you or build you up. It's hard to time the cycles. Winners and losers are created in every market, and then something changes, and another group of winners comes back. But we're still trading airline stocks. We're still trading cruise lines. We're still trading consumer staples like Mondelez and Procter and Gamble, or owning these stocks. Not everybody's a trader. Certainly I'm not. We're still owning stocks like JP Morgan. And, we're still putting money into companies like Apple and Microsoft, which is why they keep going up every day. They're not just going up. I think also that no one wants to sell them because they're winners. Nobody wants to sell the winner. We'll talk about that maybe for another day, whether or not you should sell winners and how to go about it. I like to call it more like maybe it's time to rebalance a little bit as opposed to just making an all or nothing decision in terms of selling a winner. Another thing that's very normal is the marketing pitch, okay? A lot of Wall Street firms are hitting everybody up with, the marketing pitches, how to invest in the new normal. We need to know the new normal. It's like the marketing Wall Street spin machine is telling you that you better listen to me because there's something big going on. Everything changes, and everything you have right now is all wrong. It's all going to go out the window, and you're going to lose all your money and die if you don't listen to us and change everything you're doing. And we're going to do it for you. So move your accounts and everything over to us. And I'm just not really a fan of hype-based and fear-based sales approaches. It's just not my thing. The fact of the matter is, the overwhelming majority of my clients, in fact, I would say my clientele is not really affected as far as the stocks, their accounts go. And I think this is true for most good financial advisors. There's volatility. People are down a little, some more than others, depending on how aggressive or stock heavy your account is. But if your account is stock heavy or aggressive, it's because that was part of a plan that was set forth early on to say that person could withstand and afford the volatility because they're not going to need their money for a long time. So that person could afford it. Obviously, if you can't afford volatility because you need your stock money for upcoming near-term financial obligations, then that was wrong. You should have had all your financial obligation money in the market either. I'm not talking about the money you're going to need in 15 or 20 or even 10 years, but money coming up in the next, obligations coming up in the next 6 months to a year, 2 years, even 3 years, and you're not working, let's say, and you're retired, you know that money is best off in cash. That's my feeling. You're welcome to differ. So I think most people who've if you've been investing consistently in your 401k, and you have a decent blend of investment options, and you've chosen some different kinds of mutual fund type companies, then you're probably fine. You're off a little this year. Maybe you're off 3%, 5%, 10%, 15 on the out limit, maybe flat up slightly for some of you. It's not a disaster, especially after the year we had in 2019. So that what I like to say to people, I like to say to my clients, my financial advisor friends could say the same thing to their clients. If you just look at the value of your accounts throughout this whole crazy mess we've been in 2020, you would hardly even know that the stock market has been so volatile. Yeah, at the bottom, when the market was down, like 35, almost 40% from its peak. Of course you would see that, but that lasted for such a short amount of time that if you blinked, you didn't even notice it. The bear market bottom so far is March 23rd. So by the time you got your March statement, let's say during the first week of April, your account's already recovered a lot. But that's the point. You're supposed to be invested in a way that you could stick with. Not in a way that's supposed to maximize your returns, because you also maximize your risk, your volatility. And if that happens for a lot of people, they can't stick with an investment portfolio. So the idea is better to have an investment portfolio that's less risky, but that you could stick with, because sticking with your investment plan over time is what builds wealth. It's compounding over time. Okay, just want to get that out there. So the marketing pitch is totally normal. A lot of people are pushing this new normal thing to hype you up on something. But did Procter and Gamble go away? Did Visa go away? Did Clorox go away? Certainly not. A lot of things are the same. A lot of things have been that have stayed the same, have just been reinforced. The volatility has, in the stock market has been with us since the Great Recession. We've had so many big volatile days, flash crashes, Fed policy, Fed members have misspoken, caused big gyrations in the market. We had Brexit. We had the downgrade of the U.S. Treasuries from AAA, down to AA. We've had all kinds of massive volatility. I mean, look, even the SEC is getting back to normal, because they said basically they're going to take a close look. They're taking the Hertz IPO that you heard about is halted for SEC review, which basically means that IPO is not going to happen. That's something that bothers a lot of people. At Hertz knows that they're issuing a stock that's going to be zero, just because they can sell it to unsuspecting investors. And I think the SEC has an obligation to protect us. I mean, I'm protecting my clients from that by warning them. None of my clients, by the way, not one, has asked me about it, but I'm just out here, pounding the table about that. Okay. So I don't think it's as new normal as you think. I think we're still going to practice asset allocation, and it just gets back to the same old, that the way to accumulate wealth is to stick with quality investments over the long term, diversification, either through individual stocks, exchange traded funds, mutual funds. Most people, by and large, are appropriate for exchange traded funds and mutual funds. Fewer people are okay for individual stocks. And then create that asset allocation model, how much you have between stocks, bonds, and cash, and rebalance it occasionally. And as you get older, reduce your stock holdings, raise your cash and fixed income holdings. And that's really the same old. There's nothing normal about that. And that's what I mean by saying the new normal is mostly a sales hype. It's really just a matter of getting back to basics. And that's what this bear market, I think, galvanized for all of us. Not for me, because, hey, I already know this. No, but seriously, it just basically reinforces a back to basics approach to investing in the stock market. So nothing new about that. Thank you so much for watching. A few people are out there. I'm going to take a look Hey, Roberta, good to see you. Thank you. Jerry, thank you. Steve, thank you. Okay. Judy, always out there. Love you. Okay. And we've got a couple of comments. Hey, Bill. Bill Conkle is out there. Thank you so much, Bill. You're just a terrific supporter. It means a lot to me. Thank you. Jerry's out there. Hey, and we have to have another social distancing visit, Jerry. We had a lot of fun that day. And please tell Lori I say hello. All right. I think that's about it for now. And this went on for 25 minutes, about 5 minutes longer than I expected. So I'm going to skedaddle. See you tomorrow. Thank you.